Yeah, thanks, Matt. All right, so the core topic here that we're going to discuss is selling puts on blue chip companies that are trading at a discount. I'm going to get paid to pick up a stock that I like, not because the chart looks good, quite the contrary, the chart's disgusting, but more so because it's a long-term play, right? It's a long-term play. And as pessimistic as everything looks, I mean, our roundup today was pretty pretty depressing. It makes you think it might make you think we think the stock's going to zero or the market's going to zero. It's not the case. We'll eventually get through this, but dang, I feel like we're 2000 to 2003 right now, right? Like a cyclical bear market where it just seems like they hate risk assets, period. This too shall pass. And one of the tools, the tactics that I like to have in my playbook, I like to pick up companies. I tend to do ETFs, but when you get a good blue chip stock that is so cheap that you can't ignore, how do you go about getting exposure? That's what we're going to talk about today. And I'm going to use Verizon as the example. I'm not a big fundamental analyst guy. The funny thing is, Matt, when the market goes down a bunch and a stock that you think shouldn't be down as much as it is, you almost become a fundamental analyst because, like, I got to go look at stuff here. Am I missing something? Is this company going out of business? Do they actually still make money? Like, what are you guys thinking? It makes you want to check those things before you pull the trigger, just in case there is something fundamentally amiss that changes the outlook of the company. But you're going to see partly the thought process for how to find those types of stocks, and then how to use naked puts to get paid to buy. Okay, to get paid to buy. So let's unpack this a little bit. Let me take a look at Verizon. Okay, VZ. So here's why this is interesting to me. It's interesting to me because from a fundamental perspective, I don't think Verizon's going to go away. Okay, they're a telecommunications company. There's a lot of people who use Verizon as their cell phone provider, right? And when it goes down a ton like this, it's like, are they just getting destroyed because people aren't paying their cell phone bills? Is demand for cell phone service going down? Or is this just a cyclical decline that eventually will go back up? When you look historically and you look at a long-term chart, um, Verizon rarely, I mean, it hasn't in the past, goes down and never comes back up. Okay. So it's got a pretty good track record of being able to recover. What I find fascinating, Matt, I thought this thing was interesting at $50 and it's quickly gotten to $40. It's darn near back where it was like 12 years ago. Okay. Now, the reality is you've gotten paid dividends for 12 years. So if you take those into account, you're still ahead of the game. But it's just bananas that during this bear market, you've seen some marquee names, Disney being another one, where you've seen like a decade of gains wiped out. And I think it illustrates one thing to me above all else, and that is the difficulty sometimes of stock picking, where you can get a good company and then you get a bear market and you get back a ton of gains, which is part of the reason why I like buying ETFs and having diversification. But I just think Verizon's at a level that is quite interesting to me. I can't point to any major support zones. The reality is it's cleared or breached about every support zone that I would have identified from $62 down to here. It's more so just that it's gotten so beaten up and the premium and the naked puts is interesting and the dividend yield is interesting, that it starts to become compelling to me. So when you look at Verizon, because it's gone from $62 down to about 42, it's down about 33%. Its dividend has not gone down. In fact, the dividend keeps going up over time. And because of the price discount, it's now trading with a dividend yield of 6.12%, which basically right now, every quarter, you're getting paid 64 cents. Matt, I'm turning into Greg here with this segment. I'm getting paid 64 cents every quarter. Take that times four. It's giving me $2.50 of cash flow every year. And it only cost me $41 for that. So you divide it by the 41.80. That's where you get your 6.12% yield, right? So as Verizon goes lower, if you think the dividend is safe, it becomes more compelling. That's the first thing. So the second thing, What do you do? Well, listen, the chart looks terrible. All right. I cannot make a bullish technical case on this whatsoever. But one thing that I do find interesting of the last 6 months or so is this does get extended to the downside, and you have seen periods of recovery, right? Like the last two times this got really oversold. Here you had maybe 3 months of upside. Okay. Here you had 6 weeks or so of upside. So it does go up. Okay. It's not just going to go straight down forever. And it's getting pretty oversold here. Pretty oversold. I mean, 46 was basically the last pivot high. You're down to 42. It's down 10% in the last couple of weeks. It's pretty ugly. So I start to look at, I wonder if I can sell some puts down at 40 or 39 or 38 and get paid for my willingness to A, get some bullish exposure, and B, be a buyer down at those prices. And so I was looking at this in preparation for Trade Masters last night. September, you don't have enough time. There's only 2 weeks left. So I was looking at the October options. And unfortunately, they've been a little slow in adding additional strikes. The longtime traders know that when the market moves a ton in one direction or the other, 6 months ago or 3 months ago, or whenever they listed October options initially, they're like, listen, we're not going to get down to 35. You don't need strikes down there. You're crazy. Well, listen, options exchange, we are down near 35. You need to give me more strikes because right now I just have 40 or 35. Okay. 40 or 35. I'd love a 37.50. Okay. They have them in the weeklies, but they're not as liquid. I'll get to that in a second. Let's say you are comfortable with selling the 40 put. When you sell a naked put, you're getting paid for obligating yourself to buy the stock at the strike. So if I sell the 40 put, I'm on the hook to buy 100 shares at 40. For my troubles, I'm getting paid $1. Now, when you run the numbers, how much money are they going to make me put up to sell this put? Usually they make you put up maybe 10 to 20% of the stock price. If I come in here and I sell this for $1.02, the margin requirement's about $650. 102 on 652 is 15%. That's compelling to me for a naked put. You give me 15% on a naked put where I like the price level, I'm game. Okay. So it checks the box for ROI. Okay. 15.5% or so. And when I look at the chart, again, I don't mind 40. I know it looks like we're going to go to 40 in the next day or two. Okay. But I'm telling you, it will not keep going down 10% every 2 weeks. Otherwise, it'll hit zero. Okay. You're going to get a reprieve here. What I don't know is if I should pull the trigger today, wait a couple of days, wait for more evidence. It's always a little tricky here. I am, to a certain extent, trying to catch a falling knife. And you could certainly wait for the trend to change. You can wait for more evidence if you want. I'm more playing this as a way of, hey, trying to fish for a bottom at the first sign of strength because I want the premium. I want to strike while the iron is hot because if you wait too long, you won't get the dollar. So really the question is getting $1 at 40, which puts your break even at 39, does it give me enough room for error where I'm willing to do it, right? Where I'm willing to go ahead and enter. And quite honestly, I'm kind of allowing what it's doing today to influence me. If I don't see any strength, forget it. I'll take a look at it tomorrow. Maybe I'll wait a couple of days, but it's low enough where I'm interested. Okay. And 39, by the way, is another $3 lower. That gives you an even better dividend yield. If I get that 64 cents a quarter times 4, right? If I'm still getting 256, if you assume the dividend's sticky, and I only have to pay $39 for the stock, that's now a 6.5% yield. So the lower the price I get on Verizon, the higher dividend yield I lock in. Okay. Now you may say, nope, that's too close. It's not enough margin for error for me, not interested. Well, A, don't do the trade. Go do something else. But B, maybe you can sell something a little bit further out of the money. Okay. And what I like about starting to look at the pricing of the out of the money puts is you start to root for the stock to go lower. You're like, oh, I don't like it now, but boy, if I could get X dollars for the 35 strike, color me interested. For instance, 35, I hope we'd all agree, is pretty unlikely for this thing to get to 35. And if it does, you're getting it at a price you couldn't have gotten since 2010, right? And it's like, how pessimistic are you? Like a lot of this, a lot of damage has been baked in the cake at that point. Well, will you give me a decent ROI at 35? I mean, you can get 25 cents right now. It may not sound like a lot, but listen, percentage wise, they're only making you put up 350. Okay. 25 on 350 is a 7% return. Okay. 7% return to bet Verizon's not going to get to 35, or at least put yourself on the hook for buying shares if it gets down there. Okay. I don't even find that all that bad. But if you say, no, I need, I want 30 cents, fine, go for 30 cents, limit GTC, root for Verizon to get beat up a couple more days. And maybe you get your pricing. This is the type of market, a slippery market where it just seems like it's never going to go back up. This is where you can be greedy and you can let the market come to you and you can pick your spots and say, boy, I would love to buy X stock at Y price. If it ever gets there, if I can ever get 30, 40, 50 cents to sell a put that far out of the money, I'm interested. This is the type of market to lob some things out there, because when things get slippery, when prices fall further than you'd think, you tend to get filled on things like that. So I like the October 35. The other one that I think is interesting is if you go to the October 7th weeklies, they've been around for a little bit, so they're a little more liquid than the 43-day options. They list them in dollar increments. So you could go to like the 39 strike price instead of the 40. And if you want another dollar, and you're getting still around 40 cents, and the margin requirement is 556. Okay. So ROI is still pretty good, but you're getting down to 39. Okay. So we can quibble over the details, but this, I think, is a good example, again, of a blue chip stock down on its luck, getting to the point where the dividend yield is very juicy. It's quite oversold. There's some decent premium in the out of the money puts. Sometime in the next days, weeks, I don't know, I think Verizon will bounce. And selling puts, I think, is an interesting way of trying to take advantage of it. If it's a company you like, and the fact that you're a willing buyer essentially gives you more management options. What if I'm wrong? What if it does go down to 39? I said you get to pick up some shares and hope that it doesn't go to 30 and then you're pretty close to the low. I mean, that's the game. But if you size properly and you manage properly, it could be an interesting trade. And I would not have guessed that Verizon would have gotten to $40, if you asked me a couple of months ago, which, does that mean this is fantastic, or does it mean I'm terrible at guessing? Maybe both. Okay. Maybe both. But I find this intriguing, Matt. Naked puts, a way to pick up some shares of beaten up blue chips. Verizon, I think, will be on my radar here for the next couple of months.